Hi guys, welcome back to the channel. Welcome back to another Bitcoin analysis video. And we're going to be talking about general market stuff in today's video. We've seen Bitcoin moving down quite aggressively, tapping in at that kind of $51,000 level, and obviously creating huge sparks of fear in the market. And I want to kind of showcase why I am not concerned, why I do not align to those bearish outlooks that you're seeing out there with all those scary headlines of the bull market is over, the top was in, all that absolute nonsense. And I'm going to show you the reasons and the rationale and the logical approach to the market that I have as to why I was A, expecting this move to the downside, and B, why I think the next moves are going to absolutely surprise so many people. We're going to see some fantastic runs to the upside in the coming months. Might not happen today, not next week, maybe not even in the month of August, but I am expecting a fantastic bull run for Bitcoin and for the wider crypto market, including many of those altcoins. Guys, as I get into today's video, smash that like button. I really do appreciate that. If you are new to the channel, go ahead and subscribe, tap the bell, select all the notifications, and in doing so, you will not miss another video update. Let's jump right down into today's video. So here we have a very interesting chart. And we're going to start here to give you a little bit of context over to things, right? This chart was put together to showcase the election, the US election, with the corresponding price action of BTC. Okay, so if we come all the way back to basically 2012, is it? Yeah, 2012. Over here, this is an election year. In this election year, we saw a run to the upside, a dump in August, ironically, to the downside. Okay, that move to the downside, these numbers are just phenomenal, by the way, as well. Here we can see, right, we tanked by 56.73% in August before we rallied up again. Okay, taking it from $16 per Bitcoin to $7 per Bitcoin. Phenomenal numbers, right? Then, of course, we saw a fantastic run to the upside. Now, this is 1 year after the election year. And I went through this before in a lot more detail. But here we can see that 1 year after the election in the US, we have a bull market high. 2 years, we have a bear market low point. Okay, then we have the pre-election year where we're just kind of coming out of that bear market and it's kind of stagnant. And then we get back into an election year, right? Now, let me just remove all those drawings off the chart there. As we come on over to the election year here in 2016, what do we see? Well, we see another drop from June down to August of 39.1%. Okay, and then we start rallying up into year one after the election year, where we have a bull market high. Year two brings in the bear market low. Okay, so we've got 2 out of 2, right? Not too bad. As we head on over, we do see the pre-election year being the bear market reversal. So essentially we see a bit of a run to the upside. This is met by going into an election year. Now, this is slightly different in this election year because here in 2020, we obviously had the pandemic, right? That saw a significant surge to the downside a little bit early. Okay, this was a 63.34% crash in the market, okay, happening in March rather than happening a little bit later in the year, August time. But we can, of course, see there was a correction still here from June to July, maybe even going into the beginning of August a little bit, of around 13%, nothing major. But we just saw another correction up here from August, down to September, 21.23%. Okay, this is the election year. We are kind of coming out of the bear markets, as we have seen, and there are a few corrections before we get into, of course, year one. After the election year, we see the bull market high. Okay, then what do we see? Well, we can see that year two, after, so basically 2 years after the election year, we have a bear market low point. This brings us to our pre-election year, okay, where we're just kind of coming out of the bear market. We then go into our election year. And what are we seeing inside our election year at the moment, right? This is 2024. Well, we're seeing a bit of a run at the beginning, and we're seeing these corrections right now. Okay, are they any more unusual than they were previously? No. Okay, we can see here at the minute, we are dropping down 24.26% in August, right? So we note that there's a bit of a move to the downside here. Okay, we've been ranging and we're just kind of finding support on these weekly 50 EMA, 50 SMAs. But for the most part, is there anything different across all of these election years that we have seen, okay, and how they have appeared previously? No, there isn't really a lot of difference. Every single year there is a major Bitcoin correction. It happens to also coincide, of course, that the election year is also the Bitcoin halving years. Okay, so we can argue, okay, is it the US government and maybe the Federal Reserve, or is it actually, an impact on the Bitcoin BTC halving event? Well, the halving event has very little to do with the current supply and demand and has everything to do with new issuance of BTC. So we can argue that actually it has very little impact on the market initially and actually has a long-term impact over time. However, that impact gets less and less important as the circulating supply increased so much from the very early days. So I would argue that actually what's more impactful on US Bitcoin price action is the US election and how they are politically positioning themselves for cryptocurrency and regulations, and the Federal Reserve's impact on on interest rates and so forth, right? Because each one of these kind of election years has seen some form of money printing or interest rate cuts or hikes and things like that. And I've been through that previously on the channel as well. So, as it stands right now, if history is to repeat itself, which is something that we see a lot of influencers talking about, whether that's on X, whether that's on YouTube, Twitter, even though that is X, TikTok and so forth, they often say our history is repeating itself. The top is in, we're going down now, X, Y, and Z reasons, patterns on price action or whatever, right? Trend lines broken, all that kind of nonsense. Well, if history is repeating itself, then we're actually, from this perspective, then we should be actually gearing ourselves up for some great dollar cost averaging and cumulative processes right now during this correction, because what happens afterwards is a fantastic run to the upside, right? When you'll see that bull run peaks happen in 1 year after the election year. So that'd be 2025. This is not to say that the bear market is done or the bear market is now coming in and, bull market's done, we're just going down. 2025 is going to be a bear market. Well, historically speaking, Bitcoin has not experienced a bear market 1 year after the US election, right? It's never happened in Bitcoin history. That's not to say that it can't happen, but it's highly unlikely if we're looking at historical data to say, well, if history repeats itself, next year, 2025, is going to be the peak of the bull market, not a drop in the market where we see a bear market low. Okay, that would actually happen in 2026. So taking a look at all our data here, we'd say, okay, well, we're gearing things up quite nicely. And this kind of correction that has everyone freaking out at the minute really is minor in comparison to where things could be going if they were truly bearish times. So what about the Fed? Well, the Federal Reserve have had a very interesting time. Mainly because they have obviously been creating interest rate hikes and pauses and lots of speculation around whether or not we're going to see an interest rate cut, right, or a Fed pivot, which essentially just means reversing on what they've done. They've paused for a very long time. They haven't reversed on hiking. So that's essentially what the pivot is, reduction of interest rates. Now, here's where it gets interesting. Because of all of their pauses or their failed attempts to actually do what was necessary back in 2022 and 2023, and what I mean by this is they did 0.25 interest rate hikes rather than 0.5. And we saw other centralized banks, such as the European Centralized Bank and the Bank of England, go 0.5 and be more aggressive on trying to kind of combat and fight against inflation. Whereas the Fed were a bit more hawkish. They were kind of reserved in the way that they were approaching this. They were going for 0.25 month on month rather than actually being a little bit more aggressive and trying to get that inflation down. As such, we saw the European Centralized Bank and the Bank of England basically cut their interest rates before the Fed. So we are seeing that the ECB and the Bank of England essentially have pivoted. They've pivoted already. And at that point of pivot, we see obviously these markets reacting. Next month, the month of September, is the expectation on the Federal Reserve to pivot. And again, I put this all back to the fact that they were delayed in making the aggressive action required when it came to their interest rates. So as we can see here, this is the DXY, the DXY, the dollar index. And the reason I bring this up is it's very interesting in comparison to what's gone on elsewhere, specifically with BTC in the crypto market. Now, this represents the value of the dollar. The dollar is obviously going down in value, basically meaning that you can get more dollars for every pound that you put in, or you can get more dollars for the euros that you put in, and you can get more dollars for other currencies, right? Now, when the DXY goes down, typically assets that are valued based on dollar would be going up because you now need more dollars to buy that asset. The asset itself doesn't really move in value. Its intrinsic value remains pretty static, but the currency in which you're pairing it with obviously is more volatile. The case of the dollar or the euro or the pound sterling, the yen, whatever it may be. And so when the DXY goes down, Bitcoin should go up. But Bitcoin's going down at the same time the DXY is going down. That means there is an immense amount of sell pressure, which we can see from the billionaires selling off all their stock. We've been through this a billion times already, right? And so we know that there's an intense amount of sell pressure here for BTC. The ETFs are directly correlated to the stock market. And obviously Bitcoin ETF is obviously going to have massive outflows, in my opinion. Now, there's lots of reasons as to kind of the why and all that kind of stuff. I think a lot of people are pricing in the Federal Reserve pivot. Now, historically, we see a pivot, then we see a crash. But because of the delay with the Federal Reserve's interest rate hikes, I believe that actually we're now seeing the crash before the Fed pivot. Okay, so historically, we've always seen the crash after, but I think now we're seeing it before simply because they didn't take the action that they needed to back in 2022 and 2023. Whereas we have already seen the pivot with the ECB and we've seen it with the Bank of England. Okay, so I think we are seeing the markets basically pricing it in, right? The pivot's going to come. The market's already at a really dry place when it comes to the liquidity. There's not a huge amount out there. And I think we're going to see a crash in the market, and it's going to continue a little bit more before we get better. Now, here we have the CME futures, and we can see that there was a gap that was of interest recently, this one right here between 58 and 60. That's completely filled out, obviously, as we've fallen down here, but there is a new gap that's formed, this gap being right inside here. So our expected bounce will be between 59,445 to 62,470 on the USD pairing. So we will be looking for that gap to fill out. And what I mean by that is these CME gaps have a habit of getting filled out. So we will be looking for that move to the upside at some point soon. In terms of other gaps, and here's just a reference for you. This is what we mean by when we see these CME gaps kind of getting filled out or expecting them to get filled out. We have this little gap over here that was created. It was created between the close position on Friday, the 1st of December 2023, and the open position on Monday, the 4th of December. And you can see that that gap was left behind and the market wanted to come back down and fill that gap out. Okay, so we see this time and time again. This gap here, obviously we haven't really filled it because this open and close position is just so vast. But I do think we're going to come up and we'll fill those gaps that kind of coincide together. You can see them time and time again. This one over here, for example, this gap was left behind in May of 2022, and we can see that it got filled out in October of 2023. It takes some time potentially. And you can also see more gaps in here also getting filled out. Now, this particular gap never got filled out. This is 20,000 to 21,000. Whether or not Bitcoin at some point has to go down there, I don't know, but it's no guarantee is essentially what it shows. So whereas we do have these gaps and we have had these filled in the past, there are some that have never been filled. So it's nothing is ever set in stone. Nothing is a guarantee. So with Bitcoin's most recent moves to the downside, it's very, very interesting, right? So let's go ahead and bring up my USDT pairing on the daily time frame, okay? Because we were looking to hold out some of these areas, but we got confirmed a running flat correction. Basically, we have a B wave here that is a running flat correction. And now we have this huge sell-off right now, taking us down to where our expectations lie. Okay, and this particular move or this particular area of interest is between 51,800 and 55,160. But anything lower than that 1.236 is going to trigger a more bearish move where we might start talking about coming back down to these previous areas of resistance support at 48,000 to 50,000. Okay, so I'm hopeful that we can kind of stay within the 50 to 55k range, but if we can't, then we are going to be looking at losing 50k as support, and I think that's a highly probable area at the moment as we look to fill out this C wave pattern. But I do want to kind of stress to everyone that although this is a pretty interesting kind of structure here where we can see these moves to the downside, if I zoom out far enough on this, you can see that really it's a blip on the radar in comparison. Okay, no one was really kind of complaining all that much when we saw these kind of moves from April 2023 down to June 2023, or when we saw that repeat itself again in July of 2023 down to September of 2023, right? These are very big corrections here, basically talking about drops in the market of well in excess of, let me zoom in, 20%, I believe. So let me go ahead. Yeah, 21.71%. And then over here, we also have a very similar move as well. So lots of liquidity getting grabbed, 20% moves, right? Lots of 20% moves on this way to the upside, right? No one was kind of complaining about that. But now because this market has been stagnant, or we haven't seen a huge amount of new money kind of coming into the market, again, coming down to the fact that the market is illiquid, well, we can see that this move to the downside can be quite scary to those who are uneducated towards it. It's a 24% move. It was no real different than what we have seen previously and historically. And as we said before, right, we've seen big crashes before we get into the actual bull market. This whole entire thing, right, correcting from the 14th of February down to today is a 28.25% move. We aren't anywhere near where we were back in like 2019, for example, where we saw this initial pull to the downside, where it was a very aggressive sell-off of like 51.66%. But actually, I think it's higher than that because I haven't got that wick high. So we actually saw this correction coming on in. He says if we can actually snap it to the correct wick, there we go. 53.36%, and that excludes the pandemic crash. Okay, that pandemic crash was even more aggressive because of everything else that was going on at the time of 63.98%. So I want to kind of stress, is it all that bad? Because in reality, it's not all that bad. This is holding up incredibly well, and I want to kind of stress as well that we have an overlapping nature of these candlesticks. This just shows you that liquidity is being extracted from the market and that there isn't a huge amount of liquidity left in the market. That comes once people actually start to feel a little bit eased after interest rates decrease. And that's why I think we are going to be in a very bullish time for Bitcoin in 2025. But like I say, I'm just a guy who has a history and a working career as an analyst looking at data and giving his thoughts and opinions as to what it means. You can let me know what your thoughts and opinions are when it comes to BTC and whether or not we are in a bull market or a bear market. You can let me know in the comments down below. If you found today's video useful and informative, smash that like button. I do appreciate that. If you are new to the channel, subscribe and stay up to date with all the content that we do here at Cheeky Crypto. And if you're looking for more technical analysis, check out my second channel just here, where I am covering a lot more technical analysis daily. Until the next one though, guys, have a fantastic day.